Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jeffrey Rosenkranz, Portfolio Manager at the Shelton Tactical Credit Fund. He joins me to discuss if impending rate cuts favor higher or lower credit quality debt. It's great to see you as always, Jeffrey. Welcome back to Trade Talks.
Thanks for having me. Great to see you.
You got it. And the market is currently pricing in 6 rate cuts this year, while the Fed's dot plots only show 3 rate cuts for 2024. What will the effect of this discrepancy be, and how can a fixed income investor position for it?
That's right. And over the near term, we would expect those two things to converge as the Fed gets closer to actually starting to cut. And even just recently, the market has come off of 6 or 7 cuts to closer to 5 for this year. And it's really changing by the minute. But as we get closer to the Fed actually starting to cut, longer duration bonds should start to perform even better. But really, both high quality and low quality debt should do okay if we don't get a really hard landing. But that's really a key question right now.
Well, let's dive into that more. Do impending rate cuts favor higher or lower credit quality debt?
Right. We think both are okay here and should do well. Again, barring either a very hard landing, in which case you'd want to avoid lower quality debt, or a no landing scenario where the economy really just reaccelerates and forces the Fed to start maybe hiking again or keeping rates where they are for an even longer period of time. But in most reasonable scenarios, high quality and low quality should do okay. We tend to favor higher quality and a little bit longer duration here. But yeah, again, both should do okay in the upcoming environment that we think we're going to see.
And last time we spoke, the Fed was still hiking rates, and we talked a lot about how the Shelton fixed income team was defending against these hikes and positioning for the eventual peak and pivot lower in rates by moving up in quality and starting to go longer in duration. How does the team plan on adjusting the portfolio as the Fed actually starts cutting rates?
Yeah, great question. Again, we got that big rally November and December. Maybe things went a little bit too far too soon. And so we dialed back duration a little bit, expecting maybe we'd give back a little bit on rates and that they'd be range bound a little bit here in the first quarter. But as we get closer to that first cut, we're going to start extending duration again, because in our experience, 10 years and out in the yield curve really starts to perform well once the Fed actually starts cutting. Which we think is coming May or June. The market has moved away from March. Now March is less than 50-50, but we're looking to May or June for that first cut.
All right. And kind of front ran me here for a moment here, Jeff. Let's talk more on the macro side for a moment. What are economic indicators telling us for 2024? Because the talk of a hard landing and a potential recession seems to have waned, to your point earlier. And the country seems less pessimistic about the economy. Have Powell and the Fed achieved the elusive soft landing?
Well, we don't think victory can be declared yet. It's really tough to achieve a soft landing, and historically speaking, it's very rare. So it's premature to say that at this point. And the longer the Fed keeps rates high, the greater the chance that the landing is going to be bumpy. And so if they don't really start cutting in May or at the latest June, then we run the risk of a bumpier landing. And so, yes, the general market consensus seems to be that we're gliding towards a soft landing, Goldilocks, everything is fine. I think it's a little bit premature. Some of the economic statistics that are more leading indicator type statistics are showing that we are getting some slowing here. And again, if the Fed doesn't start cutting soon, it's going to exacerbate that issue and maybe push us into a little bit bumpier landing.
All right, Jeffrey, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks for having me.